Hello everyone, welcome to a new video. Wallbox, which designs, develops and distributes EV chargers mostly, it also does other things and has other lines of businesses, but its main core business is really on EV chargers. Just reported their earnings this past March 16th, and in today's video not only we will be looking at the earnings that they provided, the guidance also for this upcoming year 2022, but we will compare all of these numbers to the initial forecast that they gave when they announced that they were going public, which was about 9 months ago. And finally we will of course look at the valuation, and I will also share some thoughts on where I see this stock being and what are my future plans with it. With that said though, and after I remind you that if you enjoyed the video, it would be really super awesome if you could just give it a like. Let's go for it. Wallbox, just very briefly, it went public this past September, beginning of October, through a merger with a SPAC, which a SPAC is a special purpose acquisition company, and as most of these companies, they start trading at around $10 per share, and Wallbox has reached so far an all-time high of $27.5. You don't see this in the graph in the screen, but if you go to the 52-week high, you can easily see that number there, and that's because it was a move intraday. And as I mentioned already in my previous video, in which, by the way, if you want to have a bit more of an introduction to Wallbox and so on, I recommend that you go and watch that one. It will be just linked here above and also down below in the description. But in that video, I mentioned that I would start a position in Wallbox as I did find the company very interesting and with a bright future, and also it was a Spanish company, so I felt somehow attached to it. I did buy some shares, but actually I sold out of my position at $20 per share, so I basically doubled my money in a bit less than a month, which was pretty crazy. And I did so because there was a lot of hype. I mean, if you have been following SPACs or just IPOs on the EV vehicle space, there's just so much hype going on that companies just skyrocket, and then of course as the hype fade away, they start going down. So I saw a bit of hype there and I basically sold out of my position. I don't regret having done so, but Wallbox is a super interesting company that I do keep in my radar, and it could be that in the future I do start a position again. Anyways, let's go into the results for this past year 2021, which I can already advance that at least in terms of revenues, these were very, very good. They reported 71 million euros for the full year 2021, which were up 263% year over year, and this is pretty crazy. Of course, the company is still very small to be publicly traded in terms of revenues, but the potential is huge long term, and the growth rates are still expected to be above 100% for at least the next year or the following 2 ones. On the bottom line though, they lost 57 million euros, so they are an extremely unprofitable company at the moment. But on the other hand, the good news somehow, if we can put it this way, is that they still have $193 million in cash and equivalents in the balance sheet. So they still have enough for at least another 1 to maybe 2 years of burning through cash. Then on guidance for this year 2022, they are expecting revenues to be between 175 to 205 million euros, representing year-over-year growth between 145 to 190%, which is again really crazy. And what I would like to compare now though is how do these numbers that we just saw and the guidance compare to the forecast that they initially gave when they announced that they were going public. And if we go into that, we see that all the numbers are in dollars. So what I have done is just convert the euros into dollars. And on revenues first, this year they were initially forecasting 230% year-over-year growth, and in the end this growth was of 263% as we saw for 2021. So there was a bit here, and reaching $86 million in revenues instead of 79 million. And going down, we see that the gross margin was expected to come at 39%, but in the end it was a bit lower than that at 38.2%. Finally, the EBITDA margin was expected to be negative 47%, and it was negative 69%, so much worse than expected. And this is with the GAAP EBITDA. But even taking their adjusted EBITDA, the margin was of 63%, very far from the 47%. Overall, last year was good in terms of revenues, but not on profitability, which I will comment more later on. Then if we look at the guidance for 2022, as we mentioned, they are expecting to report between 175 to 205 million euros, which if we convert to dollars at the current exchange rates, this means between 193 to 226 million dollars, and the forecast was of 224 million. And what I basically see here is that unless they go for that high end of the range provided, most likely they will miss on these revenue estimates that they gave. On the other hand, it is true that the main currency of Wallbox is euros, and the euros, since they made this forecast about 9 months ago, have been devaluated significantly against the dollar. So if the exchange rates were to now the same as when they did this, most likely they would be able to reach those goals. Let's see, of course, how the currency exchange rates evaluate, but that's also something to keep in mind. And then, unfortunately, other than revenues, they didn't guide for any other metric for the full year, so we cannot compare anything else. The good thing is that for the first quarter, they did guide on gross margin, which they expected to be of 37%. And if they really maintain this 37% throughout the whole year, this means that they will also miss on the gross margin, because the guidance or the forecast that they provided was of 40% gross margins. And if this is the case, then most likely they will also miss on EBITDA. On fundamentals, it is clear that this is a company in a high growth phase that is nowhere close to reaching profitability anytime soon. But let's compare it to some other competitors, or at least other players in the space, because I know that the companies we will be looking at are not exactly doing the same, but they are also operating within the EV charger space. So I feel like they are pretty good in terms of comparison and also for the valuation later on. But when doing so, we see that Wallbox, not only it is the one growing the fastest, but also it is the one with the best net income margins, which is quite hilarious, because what I'm basically saying is that a negative 80% net income margin is the best of the three. So when putting it this way in context with other companies, we see that now all of a sudden the numbers of Wallbox don't look so bad anymore. Also, Wallbox, although it is a European company, it is investing aggressively in the US, and proof of that is that first they are building a factory there to be able to produce chargers, and secondly they also had an ad during the Super Bowl, which, in case you're not familiar, the Super Bowl is a crazy event in the US, and it is also very famous for the ads displayed there, which are super expensive, but they get a lot of media coverage, and also they reach a lot of people, especially of course Americans. And they did have an ad there. I don't know how much the cost was, but they did mention that it was quite successful, and they actually closed on several partnerships because of that, or because at least it got so much reach. That said, let's look now at the valuation metrics, and since Wallbox is unprofitable and doesn't produce any positive cash flows, I have just used the price to sales ratios. But firstly, looking at the market cap, this is of around $2.3 billion currently, and let me also say that the number of shares outstanding that I will use for the calculations of the price to sales ratios is based on what Wallbox mentioned in the call, which is different from what you will see if you go to platforms like, for instance, Yahoo Finance, as the ones that I will be mentioning include possible dilution, and in this case I would try to be very conservative with the shares outstanding whenever projecting price to sales ratios, valuations, and so on, because the company is burning through a lot of cash and it's very likely going to dilute more shareholders also moving forward. Anyways, we have that the price to sales ratio for 2021 sales is of 27 times, and the forward price to sales ratio based on what they expect to report in 2022 is of 12 times. And how do I see this? Well, expensive, but compared to how many other companies were trading about a year ago when there was so much hype in the market and so on, not that expensive, as many of these other companies didn't have expectations to report such high year-over-year growth numbers as Wallbox expects. And to get a better picture, let's compare Wallbox valuation with that of Blink and ChargePoint, and we see that the other two companies are also trading at similar price to sales ratios, with Blink trading extremely expensive. Personally, if I had to choose between one of the three companies, I would certainly go for Wallbox, as I feel like it is the one with the best balance between the expected growth rates and the current valuation. However, this doesn't mean that it is cheap. With everything that we have looked at, and to wrap it up for today, if Wallbox reaches or falls to around $10 to $11 per share, I might start a position again. I feel like this is a company that can provide very attractive returns and has a very bright future ahead. It's trading super expensive, but on the other hand, it's growing so fast that it very easily can catch up to the valuation, at least in terms of price to sales ratios. But for me, as I mentioned in my previous video, this is not a company that I would feel comfortable investing large amounts of money because it is really risky. And actually something that I would mention is that I would be very careful when investing in EV companies because there's a lot of hype at the moment. Yes, it's true. We are going to see this transition because already many different brands of vehicles have announced that they would be going all electric in the coming years. But I would be very careful because there's a lot of hype, and if growth rates are not met or they don't grow as expected, it is likely that valuations will take a hit. But let's see. And then the final thing is that, of course, this is a Spanish company, so I feel somehow attached to it. Also, it has its headquarters based in Barcelona, which is my home city, and somehow I also want to invest in it because I want to be part of the growth story, because if it does well, this will also mean more jobs and just a better economy in general for Spain, or at least for Barcelona, and that's of course something positive. Anyways, please remember that everything I shared in this video is based on my research, my opinion, and my calculations, which of course all of them could be wrong, and I take absolutely no responsibility because I am not a financial advisor, and you should always do your own due diligence whenever investing in this or any stock. With that said though, what are your thoughts on Wallbox? Do you own any shares? Do you like how the company has been performing? Are you planning on buying any shares? Please let me know in the comments below. If you enjoyed the video, then don't forget to give it a like, subscribe to the channel if you're not yet subscribed, and as always, see you next time.